Thank you for joining us today on Symington Says. I'm your host, Dawn Symington, and in the studio we have Rick Cech, and he's a CPA with Cech, Rosso Company, located in Sterling Heights, and he's here to answer our questions on individual tax returns. How important is it to work with a qualified tax preparer, a CPA, versus how important, what's the difference between a CPA and a tax preparer, and what's the significance of working with a CPA?
Well, it's important to work with a CPA or someone that is qualified, because anyone can hang up a shingle and say, I do taxes. And the problem is that regardless of who you have do your tax return, you're the one that's signing the return, and you're ultimately responsible for what's on that return. So working with the CPA, you have, number one, a person that is licensed by the state. They have a certain amount of education in order to get that licensing. In addition to that, you have 40 hours per year of continuing education that you have to take. And before you can be a CPA, you have a one-year internship. And finally, the CPAs have rules of conduct that they have to follow according to the Michigan Association of Certified Public Accountants. And if they don't follow those rules of conduct, they're out of the association, no longer being a CPA. So it's important to know that whoever you go to, you can trust what they're doing, because if there's an error, let's say it's in your favor, well, that's good as long as you don't get caught by the IRS with an audit. All of a sudden, then it costs you tax and penalties and interest and everything else along with the aggravation. But the error, just as likely as it being in your favor, could be against you, where you're paying more in taxes. And if it's not caught by an audit, you're just out the money.
Okay. What qualifications does somebody who's qualified but not a CPA need to have? Is there specific licensing requirements as a tax preparer, or there's no requirements?
You can become an enrolled agent, in which case an enrolled agent takes an exam to practice before the Internal Revenue Service. Other than that, while in prior years there were no requirements for being a tax preparer, now if you're a paid tax preparer, you do have to file with the IRS, and there are certain continuing education requirements.
How do you know whether you should itemize deductions or take a standard deduction? And maybe you could explain a little bit of what the difference is between standard deduction and itemization.
Okay. Well, number one, you take whatever gives you the biggest deduction.
Okay.
The standard deduction, if you're single, is $6,100. If you're married, is $12,200. So you get that without having to identify any individual deductions. Everyone just gets that. Now, if you itemize, it's because when you take all your qualified itemized deductions, which could be medical, could be real estate taxes, could be license plates on your car, state taxes that you pay, mortgage interest, charitable contributions, gambling losses, accountant's fees, all of those things. If the sum of all of those are greater than the standard deduction, then you'd want to itemize. If they're less, you just take the itemized deduction, or you just take the standard.
What types of items can you deduct as a medical deduction?
For medical, and they've just changed it. It used to be, first, your medical expenses had to exceed 7.5% of your income.
Okay.
Now it's 10%, unless you were born before 1949, which case it still stays at 7.5%. Oh. But the things you can deduct there are any medical insurance premiums that you pay. If you pay for dental insurance premiums, you pay your dentist, you pay your doctor, you pay labs, out-of-pocket hospital costs, prescriptions, co-pays, mileage going to and from the doctor or to for lab work. Also, long-term care, depending upon your age, determines how much of a deduction you get, but the long-term care premiums can be deductible.
I see, I see. Is Social Security taxable?
Well, in some cases it is, in some cases it isn't.
Okay.
There's a formula that you go through, and basically, if you're single, the formula is half of your Social Security plus all your other income. If it exceeds $25,000, then half of your Social Security, or 50%, is taxable. If that number exceeds $34,000, then 85% of your Social Security is taxable.
Okay.
Okay. If you're married, it's $32,000, which is half of your Social Security plus all your other income. If it exceeds $32,000, that excess 50% is taxable, and if it exceeds $44,000, then 85% is taxable.
Okay. In what cases would you get a K-1 form?
Okay, a K-1 is given if you own a partnership, a LLC taxed as a partnership, or an S corporation. And the reason that you get the K-1 is those types of entities don't pay income tax or federal income tax on their own. So what happens is whatever income or losses or deductions or credits they have, they're passed through to the shareholders. And so the K-1 form is prepared by the company and given to the owner of the entity and the IRS so that the owner knows what to put on their return as far as income, losses, deductions, and the IRS knows what to expect.
So what do I do with a K-1 when I get it? Is it logged in a separate form?
There's you take the information and it goes on a number of different forms.
Okay.
Some of it goes on a Schedule E, some of it goes on other forms, some of it goes to your itemized deductions. So there's a wide variety of places that the K-1 information can go.
Are there limits on what can be deducted for charitable donations, whether they're monetary donations or donations of clothing or articles and goods?
Yes. For cash contributions, generally 50% of your adjusted gross income. So you can give a lot and still get a deduction. Now keep in mind with cash contributions, if it's over $250, you have to have a acknowledgement from the charity that you gave that contribution. For non-cash contributions, if your total is under $500, no problem. All you do is put it on the Schedule A to itemize the deduction.
Casino losses. Can you deduct losses from casinos?
Only if you,
Gambling?
number one, have gambling winnings. So if you're reporting income, you hit the lottery and you won $10,000. If that's the case, then if you have losses for that year, whether it be losses at the casino or lottery tickets, and you itemize, you can deduct those losses.
How do you get the proof of your losses?
Well, if it's lottery, hopefully you save the tickets. If it's at the casino and you have some type of casino comp card, you can go to the casino and they can print you a win-loss report.
Nice, nice.
One thing you want to keep in mind with deducting losses is that for the federal government, you can deduct your losses if you itemize and you have winnings. For the state of Michigan, you pay taxes on the gains. You don't get to deduct the losses.
Thank you for clarifying that. And if I have gains, such as $10,000, and I have losses of $12,000, can I have a loss of $2,000, or am I limited to my losses to equate to my gains?
No, you can only deduct the losses up to the gains. So you get $10,000, the other $2,000 is just fun.
Why do some people have to pay estimated taxes? And I mean that is quarterly taxes, correct?
Yes.
That'd be quarterly.
The reason that they'd have to pay estimated taxes is The government looks at the tax system as a pay-as-you-go type system. And so if you don't have enough withheld from your pay to cover your taxes, or you have other sources of income, whether it be rents or capital gains from the sale of stocks, self-employment income, or income from K-1s, nothing is being paid into the government on that money. And the federal government expects you not to owe more than $1,000 at the end of the year, and the state about $500.
Okay.
The problem is if you do owe more and you should have paid estimates, there's penalties involved. And while the federal penalties are not that significant, the state of Michigan hits you with a 25% penalty plus interest.
If you exceed $500 in payments.
If you owe more than $500 at the end of the year and you should have paid estimates.
Are you ever asked why your client has to pay taxes, why someone else gets a nice big fat refund at the end of the year?
Yes, it's surprising, but that happens a lot. And the problem is that no two people have the exact same income, and even if they have the same income, did they have the same withholdings? Because one person can claim married in 2, the other person can claim married in 6.
Okay.
In which case, the one with married in 6 has a lot less withheld on their pay each week, and they may owe or may not owe. They could have rental income, or they sold stocks, or they have dividends, or they itemize and one has a mortgage, one doesn't. And it's things like that that would cause one person to get a refund and the other person to pay.
That's it for today. Thank you so much for joining us.